Hello and welcome to Business Today. I'm Siddharth Zarabi, and with me now at our studios for the Davos Brainstorm 2025 is Amitabh Chaudhry, the Managing Director and CEO of Axis Bank. Amitabh, welcome.
Thank you so much.
I want to begin by extending congratulations. I'm sure you had hundreds of them for a third term.
Thank you.
That's been approved for you till 2027. So Axis Bank, you've been at it now. In this term, what is the kind of agenda that you are looking forward to fulfill?
So when I joined Axis Bank, obviously we had certain challenges. We had balance sheet issues. We had, in my mind, a certain level of aspiration which needed to be raised. We had to fix some of our technology. We had to fix some of our processes. So they were what I would say low-hanging fruit. I mean, in the sense that you knew what you had to do and where you wanted to bring the franchise in terms of creating finally a platform which can go and compete very effectively in the marketplace. I think these last 6 years we have done that quite successfully. I think how people perceive us as a brand, how customers, stakeholders, even competitors, I think we definitely moved up in their eyes. We also did the Citibank acquisition through this period and did it quite successfully. Now, in the next 3 years, I would ideally like to use this platform to take Axis Bank to the next level. I mean, in the sense that we, for example, a couple of years back, launched something called Sparsh, which is about customer centricity. We call it customer obsession. So I would ideally like the end of these 3 years for a lot more people to say that if you want the best customer service in the industry, go to Axis Bank. And once you are with them, they never leave you. In the right way, I mean it in the right way, and I want to create that differentiation if we can in the next 3 years. Now, whether 3 years is good enough for it or we need more time, only time will tell. But we do have the platform today and the right people to be able to make it happen.
Since we are here at Davos, it's a very interesting time to be here. Every 4 years, a new US president is sworn in. That's happened literally less than 4 hours ago, and already. Lots of news flow. The latest, as we just walked in for the conversation, viewers, at least I just saw that the US has pulled out of the OECD, that's a global treaty on tax cooperation, and we don't know how many more such pullouts will happen. But broadly speaking, for the global banking space after COVID and all the disruptions that we saw, how is the world of capital flows and interest rates looking to you this 2025?
So if you look at what is happening globally, Fed was on a path to reduce interest rates, but at the same time, if you watch what Trump is saying and what he intends to do with higher trade tariffs, with where the fiscal deficit is going, I think the runway to be able to cut rates is reducing quite sharply. I think you will see over a period of time they might have to, or they might be forced to increase interest rates, because as fiscal deficit in the US keeps rising, and if you add what Trump wants to do to it, the outstanding debt of the government and the fiscal deficit will only balloon from here. And so the investors will demand a higher price, is our view. So in that sense, you might see actually an uptick in interest rates in the US. Europe is a much more difficult proposition. It has other challenges. Growth is not there. Immigration is already becoming a problem, and they need to tackle it somehow. People need to come together. There's a lack of collaboration there. In India, the global macro looks tough right now, but I think we have done a great job in terms of collaborating with the nations in general and being seen as a country which people want on their side. While we have seen tightening of liquidity, we have seen that the deposits and the credit growth has been muted as a result of fiscal and monetary tightening. But I think we have very smart people working in some of these institutions and the government, and they know how this needs to be managed upwards. And I'm quite hopeful that things will hopefully ease over a period of time. The biggest global macro which will keep coming all the time is something which you just mentioned. I think Trump will be very active in the next 12 to 18 months, and every time some action is taken, it will have some ripple effect across the global economy, including India. I mean, India can't be oblivious to what is happening around the world. So while we remain a great growth story, while we remain very optimistic about what India can do, you might see this volatility which could cause a bit of a problem, and we have to be watchful.
The United States and the tax cut agenda that President Trump has would mean that they will have to raise the revenues, and perhaps the external revenue service that has been set up is a precursor to that, to be able to raise revenues. We don't know what will come of it, but you spoke about US Fed. If that were to be the US Fed stance, and if the US Fed sneezes, the rest of the world catches a cold, how will that play out, particularly from the point of view of what we saw happen in bond prices in 2024? What's the likely scenario there? Amitabh?
So while people in India are expecting a rate cut, my view is that rate cut is not going to make too much of a difference in terms of, either spurring GDP growth or anything of that nature. That will be seen more as a signal. So my view is that India today, given where inflation is, what printing on the inflation side is happening, inflation has turned out to be higher than what was being predicted. RBI in its last monetary policy has very clearly said that they are very clearly focused on ensuring that inflation is brought down. If given all that agenda which exists, and given what has happened to the rupee, and given the fact that US is talking about printing more money to follow Mr. Trump's agenda, I think India has to focus on some of the other factors like improving liquidity, like looking at some of the macro changes which RBI has brought about, or is talking about bringing about, and thinking through as to what impact it could have on the credit and the deposit growth rate. So my rate cut I see more as a signal rather than actually really having a real impact.
Fundamental difference.
But the real work needs to be done on getting the credit impulse back in the economy, ensuring that the liquidity is there. At the same time, while RBI is worried about some sectors or some asset classes, they need to be managed much more actively so that the other parts of the economy are not getting hurt because just the credit growth is being controlled in a very tight way.
What indeed is happening to the rupee? We have seen the recent sort of volatility. We also know that the RBI has drawn down on its reserve to a very substantial number. What's the outlook for the rupee that you are kind of mentally working with as a banker?
So I think, obviously they try to defend the rupee, and in the process, a lot of reserves have been used. I think over the last month or so, we have seen RBI easing off on that strategy, and so rupee has fallen sharply. Right now, a bit of a dollar trade is going on. Hopefully, it will stabilize at some stage. But it changes every day. We are expecting some tariffs to come in. Then suddenly announcement comes that okay, maybe I will review it for some time, and you see suddenly that the dollar is not appreciating as much. So taking the volatility out, I think rupee will depreciate slower from here because that dollar trade has played out to some extent. But difficult to predict because we don't know what's coming, as you rightly said, coming down the pike in terms of what US will do. If tomorrow they were to suddenly impose tariffs, if some country does not do a deal, it will have a negative impact and that dollar trade will again pick up. So difficult to predict, but I would say if you take the volatility out, a gradual depreciation from here on, because a sharp one has already kind of happened to some extent.
Okay, gradual depreciation from here on. Let's turn to the overall health of the banking sector in India. We've witnessed a slowdown in credit growth. There are concerns around consumption, and that all of that has sort of reflected in the headline number also falling. The regulator on the other side has been worried about unsecured loans. In this entire mix, what do you see happening to credit growth in the current fiscal?
So regulator has been spot on in terms of seeing some of these risks and warning the banking sector and taking some real measures to slow down the credit growth, especially on the unsecured side. And they need to be given full marks for that. My view is that if things continue the way they are, the deposit growth will remain in the same 10 to 11% zone. And if RBI continues to stick to a policy that the credit deposit ratio or the LDR also needs to be maintained in line with what the deposit growth rate is, then credit growth automatically gets restricted to the same number. Now, if government feels that slower growth is having an impact and it's feeding into the overall growth rate in the economy itself, then I'm sure RBI and government will sit down and see what can be done. But right now, based on whatever we know, we are not seeing substantial change happen in the next fiscal.
Amitabh, what ideal mix of policy should the fiscal authority and the monetary authority adopt in the overall current macroeconomic scenario?
So again, our view is that the government on the fiscal side is very committed to bringing the deficit down to below 4.5%. I am quite confident. I mean, I don't know the insights at all that the government will stick to that plan. I think you have to give full credit to the Modi government that they have maintained a certain fiscal discipline, and there is no reason why they will shift. I think there have been some unintended consequences of both the fiscal and monetary policy to some extent. On the fiscal side, for example, government rightly so had imposed some conditions while giving money to the state government. Now state governments have not been able to meet those conditions, so some of that money has not been spent. I'm sure government is looking at it. On the monetary side, because of some macro tightening, some looking at some of the measures that have been taken, the credit growth has come down, and RBI is realizing that liquidity is not there in the system, and it's got hurt with the recent FX intervention. So RBI is now talking about how they can bring liquidity back. So as I said, the people sitting in the positions of power are very smart and intelligent people, and obviously they are watching what's happening, and I'm sure some measures will be coming our way. But letting go of fiscal discipline, in my mind, will not be the right thing to do. And at the same,
will perhaps not send the right
signals across the world, and in terms of what India is trying to do. And at the same time, on the monetary side, RBI has been, recognized as someone who spotted some of these risks, early on. But I think because of what has been done in quite a rapid fashion, the credit growth has got impacted in a pretty significant way. And RBI does need to find a way as to how to, on one side, ensure that there is no unbridled growth in the sectors which are riskier, but at the same time allow for credit growth to happen in the sectors of the economy which is needed for an overall economic growth to come back.
And that's not so easy to do, actually.
It's a balancing act.
Yeah.
So you have to kind of keep balancing it as you move forward.
When you take a look at the sectors across India from a private investment perspective and the demand that comes to you, what sectors do you see performing better in the next 12 to 18 months?
So if you look at the two sectors which actually did not do very well were real estate and utilities. And frankly, now with the some of the macroeconomic factors playing out on the real estate side, obviously there was a lot of excess inventory, all of that has gone away. There are nucleus families, people want their homes, quality of construction is improved, and so on and so forth. I think on the real estate side, we do see pickup in demand, and that feeds into various sectors of the economy.
But isn't that demand at the higher end rather than in the mid or affordable
So we are
segment?
hoping, as things pick up, we are hoping that obviously it will go to the lower and the middle segments also, because when we are talking to the developers, they are seeing decent demand in some of those areas. Obviously, because first they were trying to exhaust inventories. Now the building has kind of started. So we do expect real estate will pick up. We also expect that the private capex in manufacturing, especially which is focused on the export sectors, when you look at the China Plus One strategy, when you realize that, with even in spite of all the tariffs, there are a lot of, specific industries in which India is gaining momentum. Then, and also government is quite, for example, in China Plus One, which means that electronic manufacturing, government is talking about spending a lot of money in defense, space. There is a 19 lakh crore plan on renewables and energy side. That will mean a lot of investment. So in my mind, there are very large sectors which government has identified for investment, and they're opening up those sectors, which could and should mean that the capex will come back. Now, we have been talking about capex coming back for quite some time, so I'm cognizant of that fact, but I think it takes time for some of these policy measures to kind of feed through the system. I think they are slowly, gradually kind of feeding through the system, and you will see a uptick in demand and capex.
I know my viewers, some of them would at least want me to ask you about a further point on Axis Bank and what measures you are taking, particularly, for example, on deposit growth and to deal with the risk side of the equation. What can you share with us?
So on the deposit side, we are very clear. I mean, one of the reasons we acquired Citi was to, have a good mix of mass, set of customers who are at the kind of slightly low level to affluent side. Today, our private wealth management is one of the largest players in that particular segment. We have been working on a project internally to set a certain way in which we go about identifying the customers which we want to get into the Axis fold, and how do we ensure that over a period of time a bigger share of the wallet is actually being banked with Axis. We have been on this journey for some time. It's a project called Project Triumph. We are seeing green shoots across. Obviously it will take time because as you sign up these customers, it takes time to build those relationships. Obviously, with deposit growth being a little bit constrained, the overall deposit number might not look great, but underneath that number, there's a lot of positive stuff which is happening. On the credit side, we keep looking at our risks all the time. We keep course correcting. Our underwriting standards are, we believe one of the best in the industry. And as we see risks emerging, we obviously go and take risk actions to ensure that while stock might have a little bit of problem, the stock which is getting added or the new stock that is getting added is coming in at standards which are commensurate with the kind of risk we want to take and the pricing we get. So while we are seeing slippages rise, we believe that it's a temporary problem, and in the next couple of quarters will be more than under control. And we are using this time also to continue to improve and better our platform in terms of grabbing the opportunity when the kind of growth starts coming back. So our investment in improving customer journeys, using more technology, all that is not stopping because we are going through slightly elevated period of elevated stress.
Since we are on the subject of deposit growth, I want to end this conversation by relating what another banker said. He said for a deposit growth to happen, the equity markets will have to fall.
Yes.
Considering what's happened, what would you?
No, so our view is that while people might be investing in equity, the money does come back to the banking system. End of the day, someone is buying, someone is selling. The problem is that the nature of money which is coming to the banking industry is changing. It goes from an individual and comes to us in the form of a corporate deposit. So it comes at a higher price. It also, and if it comes from a financial institution, from an LCR perspective, we have to ascribe higher outflows to it.
Correct.
So the price goes up because people are investing in the equity market. The money still stays in the banking system. So it is not impacting deposit growth, but definitely impacting cost of deposits.
Okay, one final quick point, and this colleague told me to ask you that what's the thinking on the possibility of merging Axis Finance with Axis Bank? Is that something that you've been asked and you have considered?
So, well, based on the latest draft guidelines of RBI on what businesses the banks can do and what business should be housed in various subsidiaries, if it was implemented as a regulation, we would have only two choices. I mean, there are choices between, but frankly, they're not very ideal or optimal. We will either have to absorb Axis Finance into Axis Bank, or we will have to sell a substantial stake in Axis Finance to, some promoter or some fund. Let's wait for the guidelines to come, and we will decide what is the best option for us. The size of the Axis Finance balance sheet is not going to make too much of a difference to Axis Bank and its overall scheme of things. But we are also very cognizant of Axis Finance customers, the employees who are Axis Group employees in that sense. So we'll take the right decision at the right time. It's not that we need capital desperately. Our capital ratio is now, CET1 is 14.5, very comfortable. And this is after absorbing Citi acquisition completely. This is after higher risk weights on, some of the RBI came out with higher risk weights. So we had to absorb a 70 basis point impact on our capital. So we are quite comfortable. But we'll take the decision at the right time. We don't want to be in a hurry.
Okay. As I let you go, have you started replacing Citi cards with Axis branded cards?
Yes, that process has started. It is going quite well. Please understand that when we do recording, as per RBI regulations, people have to go to our application and reset their limits. I cannot set it on their behalf. So we are we realized very quickly that Citibank customers are wondering why suddenly their card stopped working in some locations because they have not set those limits. So we are now spending time, we are kind of just slowing down the process to ensure that we educate them first that when it will come, you have to do 1, 2, 3, 4. Because we don't, want to cause a problem, but as per regulations, you're required to do it. So once the education is done, the recording process should get done in the next couple of months.
And apps make that.
Oh yeah, you can go to the app and do. And we want you to go to the app because we want you to experience our app, which is one of the best apps, frankly, in the world. Forget about India. So we want people to experience it, and when they experience it, we do hope they start using it for other purposes.
I wish you all the very best.
Thank you,
Siddharth. With that, it's a wrap on this conversation. We'll continue with our coverage from Davos. Do stay tuned in. Thank you, sir.
Thank you, sir. Always a pleasure.
Hello and a very warm welcome. The biggest question at Davos, as it is across the world,